Welcome to the Deep Dive, powered by Talk Tickers.
Hey there.
Today, we are diving into NRG Energy, that's ticker NRG, specifically their Q3 2025 earnings call.
Yeah, this one dropped pre-market November 6th.
And it's a fascinating one. Our goal here is to really break down the numbers, the strategy, especially around, capital returns and data centers.
And tackle that big puzzle.
Yeah.
Which is, how did they post what genuinely looks like a record quarter, reaffirm guidance, boost returns, and the stock still slipped?
Exactly. What did the market see, or maybe what did it miss?
Let's try and figure that out for you.
Okay, let's start with the headlines, because wow, they were strong. Adjusted EPS for Q3, $2.78.
Right, and consensus was way lower, like $2.19 to $2.26 sort of range.
So $2.78 isn't just a beat.
It's a blowout, a massive beat.
And operationally, just stellar. Revenue came in at $7.64 billion.
Which beat estimates by, almost 7%? And up year over year, too.
Yeah, up 5.7% year on year. And adjusted EBITDA was $1.2055 billion.
Which is up 14% from last year. Management actually called it the highest quarterly adjusted EBITDA in their history. They made sure to point that out.
Okay, so highest ever EBITDA. Huge EPS beat, revenue beat. Guidance reaffirmed. We'll get to that.
And
yet the stock closes down 1.78% on the day. It just feels like a major disconnect, doesn't it?
It really does. Bullish fundamentals slamming into a wall of market caution. Maybe just broad risk-off sentiment.
That'd be. But we need to dig deeper. Where did that amazing performance actually come from? Was it sustainable?
Well, yeah, that's the key.
Yeah.
It wasn't like a one-off gain. It seems to stem from really strong execution, particularly in their Texas segment. Ear hot.
Their home turf. So let's unpack that execution piece.
Okay, so Texas segment adjusted EBITDA up 38% year over year. That's huge.
38%. Was that just a hot summer driving prices?
Actually, no. They specifically credited retail margin execution and optimization, basically managing their supply costs extremely well against what their retail customers were paying.
Interesting. What about the East segment, PJM and those areas?
That saw a slight dip. Higher supply costs were the main reason, though it was partly offset by some increased capacity revenues they received. So a bit of a mixed bag there, but contained.
And the smart home business, that seems to be quietly growing.
Oh yeah, it's performing really well. Customer growth was 9% year over year. Their own target was only like 5-6%.
So smashing that target. And it brings in decent money.
Definitely. $272 million in Q3 adjusted EBITDA from smart home. It's becoming a really solid, less cyclical contributor,
Right, diversifying away from pure power prices. Okay, let's talk cash flow, because that tells a big story too.
Absolutely. Free cash flow before growth, FCFPG.
Right, let's pause on that. FCFPG, this is the cash they make before they spend on big new expansion projects, correct?
Exactly. It's like the core engine's cash output.
Yeah.
And year to date, $2.035 billion.
Wow. How does that compare?
That's up 42% year over year. 42%. That speaks volumes about the underlying financial health.
Okay, speaking of cash and investing, there was this detail about the Texas Energy Fund, the TF. It seemed a bit confusing. They reported a net inflow.
Yeah, $30 million inflow related to the Cedar Bayou expansion project. It sounds backward, right?
Yeah.
You're building something, shouldn't cash go out?
That's what I thought. How does that work?
So the TF is this low-interest loan program from the Texas PUC, meant to encourage new generation. The way the loan was structured, NRG could count development costs they'd already spent before the loan money actually arrived.
Oh, okay.
So when the first chunk of loan money came in this quarter, it was more than what they spent in this quarter on that specific project. Hence, a temporary net inflow on the books for Q3 related to that item.
Got it. So it's more about the timing and structure of that state loan, not some magic money machine.
Precisely. It actually shows, good financial management around those specific programs.
Okay, so if everything was so good, record EBITDA, massive cash flow, solid execution, even tricky financing handled well, why the stock drop? It can't just be generic market fear, can it?
That is the million-dollar question, isn't it? I mean, execution looks flawless right now. But the market always looks ahead.
So what's ahead that could be worrying?
Two things, probably. One, the integration risk of that huge LS Power acquisition is supposed to close next year, Q1 26. Even with good financing, big M&A always carries risk.
Okay, integration risk makes sense. What's the second?
Just the inherent volatility in wholesale power markets. We saw that little dip in the East segment due to supply costs. Investors might just be demanding a bigger margin of safety or a discount on the stock price, given the complexity of managing supply across different regions like ERCOT and PJM, especially with a big acquisition looming.
Right. So maybe not doubting this quarter, but pricing in potential future bumps more heavily.
That feels more likely than just saying the market was down. It's about perceived forward risk, even if the company is firing on all cylinders right now.
That makes more sense. Okay, let's pivot then to that longer term story, starting with LS Power and the overall strategy.
Right. So the LS Power deal, as we said, still on track for Q1 2026. What I found really interesting was how they framed future growth.
How so?
They reaffirmed that 14% EPS compound annual growth rate target through 2029. That's pretty strong.
14% CAGR, yeah.
But, and this is key, they explicitly said that number is based only on the standalone company. It completely excludes any potential upside from future data center contracts.
Wait, excludes all data center upside from that 14% growth target?
That's what they said, which sounds incredibly conservative, doesn't it? It's like building in a huge cushion of potential upside they're not even guiding to yet.
Definitely conservative. And speaking of cushions, let's talk shareholder returns, because they announced some big moves there too.
Oh yeah, huge news. The board authorized a brand new share repurchase program, $3 billion.
$3 billion, wow. Over what time frame?
Through 2028.
Mm-hmm.
And on top of that, they bumped the dividend up 8%. It's now $1.90 per share annualized.
Okay, an 8% dividend hike plus a $3 billion buyback authorization. That's serious capital return.
It really is.
Yeah.
And they committed to using at least $1 billion per year for buybacks until they hit their debt reduction targets. That kind of committed buying should, in theory, provide some structural support for the stock price.
Which, as you said, might be exactly what a market nervous about M&A risk wants to see, that visibility.
Precisely.
All right, now for the part that's got everyone buzzing, data centers, AI load. How's NRG playing that?
They're definitely leaning into it and accelerating. Just in Q3, they signed up roughly 150 megawatts of new long-term retail deals specifically for data centers.
150 milliW in one quarter. That's significant. Where are these located?
Across their main markets, ERCOT in Texas and PJM in the East. That brings their total contracted data center capacity up to 445 megawatts.
Almost half a gigawatt contracted already. And these are long-term deals, you said?
Yeah, multi-year contracts, not spot market stuff. They also mentioned new projects specifically in PJM, Maryland, and Illinois that will ramp up between 2028 and 2032.
Okay, so locking in future load. And what about pricing? Are they getting good rates for this power?
Apparently so. They sounded quite confident. In fact, they actually raised their target price for new long-term data center deals.
Raised it. From what to what?
They said they're now targeting above $80 per megawatt hour. The previous range was more like $70 to $90. So lifting the floor of that range.
Pulling the bottom end up to $80 plus. That's a strong signal about demand, right?
Absolutely. It suggests the market for reliable power for AI is getting tighter, and they have pricing power.
Okay. 445 millivu contracted, pricing targets going up. But the really big number was the pipeline, wasn't it?
Oh, yeah, the particular pipeline. Through their partnership with GE, Vernova, and Kiewit, they highlighted 5.4 gigawatts of potential projects.
5.4 gigawatts, that's enormous. How does that work? Is that just selling power?
No, this is mostly tied to what they call the Build Your Own Power model, or BYOP.
BYOP, build your own power.
Meaning NRG, often with its partners, would actually build new dedicated generation resources, likely right next to or very near the large data centers. It's not just pulling power off the existing grid.
Ah, so dedicated power plants for specific data centers. Why is that model gaining traction?
Reliability and speed. Policymakers and the big tech companies themselves increasingly like it because it directly adds new, reliable, dispatchable capacity right where the massive new load is showing up. It helps bypass potential grid congestion issues and directly answers the resource adequacy question. Is there enough power?
That makes a lot of sense, especially with grid constraints being such a big issue.
Exactly.
So if you connect all these dots, the strong Q3, the focus on reliability, the policy tailwinds like the TEEF in Texas pushing for new capacity.
It really validates NRG's model, doesn't it?
Yeah.
This integrated approach, having generation, retail, and now developing these dedicated solutions like BYOP, the whole environment of reaccelerating load growth, especially from AI, seems to favor players like them who can offer reliable, large-scale power.
Yeah, the thesis seems pretty compelling. You've got proven execution, a huge commitment to returning capital with that new $3 buyback, and then this massive optionality on the whole AI data center boom. via the 445 milliW contracted and that huge 5.4 GW pipeline.
And remember, that pipeline upside isn't even baked into their main 14% EPS growth forecast yet.
Which brings us back to that stock dip. Just looks like a major divergence. Fundamentals pointing strongly one way, immediate market reaction pointing the other, temporary caution winning out over concrete results and future potential.
Seems that way.
Okay, perfect time transition. Let's talk about our This Is Not Financial Advice segment, a wild yet plausible trade idea based on everything we've just discussed.
All right, let's brainstorm.
So the setup is best quarter ever, guidance reaffirmed, M&A integration seems manageable, financing is done, and crucially, a massive, massive capital return program just authorized $3 billion, plus ongoing buybacks.
Right. The $1 billion annual buyback commitment provides a pretty strong baseline demand for the stock. It feels like the downside might be somewhat structurally limited, or at least cushioned, by that sheer volume of buying.
And the current price, let's say it's hovering around $170, seems to be ignoring that huge 5.4 GW pipeline. It feels like it's valuing NRG on today's business, plus maybe some LS power integration, a risk discount, but not the exponential growth potential.
Agreed. The market seems laser-focused on the next 12, 18 months of integration, not the multi-year, multi-gigawatt opportunity.
Okay, so here's the outrageous but plausible idea. We want to harness the certainty of those near-term buybacks while making a leveraged bet on that uncertain but potentially huge long-term data center growth.
How do we do that? Sounds tricky.
Well, one way could be using options. You could try to capture the near-term stability or even slight downside protection offered by the buybacks.
Okay, like selling some near-term options.
Exactly. Maybe sell some front month, slightly out of the money puts and calls, a short strangle or straddle, maybe slightly skewed. The idea is you collect premium income now.
Betting the stock stays roughly range-bound in the very near term because of the buyback support.
Sort of. You're getting paid that premium income.
Yeah.
And what do you do with that income?
Ah, I see where you're going. Use the premium from the short-term options.
To finance the purchase of long-dated, maybe way out-of-the-money call options, say options expiring in 2027.
2027 expiration. Why so far out?
Because those big PJM data center projects they mentioned ramp up between 2028 and 2032. And the 5.4 GW pipeline, those BYOP deals, they'll likely start getting announced and firmed up well before then. 2027 gives you runway for one or two major BYOP announcements to hit the tape.
Which could potentially cause a significant re-rating of the stock, right? If the market suddenly starts pricing in gigawatts of secured, high-margin data center contracts that weren't in the previous forecasts.
Precisely. So you're using the income generated from the perceived near-term stability, thanks to buybacks, to buy a relatively cheap lottery ticket on that massive, currently excluded long-term growth story.
It's asymmetric. The short options limit gains-losses slightly in the near term but generate cash, while the long calls offer potentially explosive upside if that BYOP thesis plays out big.
Capturing the certainty to fund the uncertainty, it's definitely a more sophisticated approach, playing volatility and time horizons.
A strategic bet that the market eventually has to price in that 5.4 GW pipeline, especially once contracts start landing.
A plausible idea for someone bullish on that long-term DYOP narrative?
For sure.
Okay, let's wrap this up. Quick recap of the essentials for you. NRG, record Q3 adjusted EBITDA. They boosted the dividend to 8%. They authorized a huge new $3 billion share buyback.
And crucially, they showed real momentum in signing data center deals 445 million now contracted. And they even raised their long-term target price for that power to above 80 millimeters.
The market, though, seemed more focused on near-term risks or broader sentiment, causing that disconnect on earnings day.
Yeah. So now the focus shifts past 2025. It's all about integrating LS Power smoothly.
And maybe even more importantly,
turning that massive 5.4 gigawatt data center pipeline from potential into actual contracted projects. That's the next big value unlock.
Which leads us to our final provocative thought for you to ponder. What will define NRG's story over the next year or so? Will it be the quiet, steady work of closing and integrating the LS Power acquisition?
Or will it be the splashy announcement of the first truly massive multi-gigawatt build-your-own power deal for a major data center client? Which of those catalysts really holds the key to the stock's next major move in 2026?
Something to think about. And as always, please remember, this deep dive is for informational purposes only.
It is definitely not investment advice. Do your own research.
Thanks for tuning in to The Deep Dive.